Okay, welcome back, Red Bells. Okay, so the last part is about financial risk or gearing, and the question that's raised here is, to what extent is the company financed by loans or in accordance with capital? So these are the two important words to keep in mind here, because where does a company get its money from? Either from the shares that's being issued to the shareholders or by taking a loan. So that's the total amount of capital. Now the first ratio here is the debt-equity ratio. The formula here is your non-current liabilities, which is also your long-term liabilities, in the ratio of the shareholders' equity. Again, share capital plus retained income, as I said in the previous information. Okay, so let's take a look at the textbook. Here's your non-current liabilities or your long-term liabilities. In this case, on page 120 again, it will be the 120,000 in ratio with the shareholders' equity, the 744,900. Now, in this case, this formula, what's important here, let's write it in here. If your answer is more than 1-to-1, then we say the company is highly geared. If the ratio is less than 0.5-to-1, then the company is low geared. So in the first case, in the 1-to-1, or if it's more than 1, let's say it's 1.5 or 2-to-1, then it means for every long-term liability, every R1 that you owe in terms of your liabilities, you have R1 in share capital. So if this gets too high, you are highly geared, and you would not recommend to take out more loans. But if you are low geared, so this means for every 50 cents that you owe in terms of a loan, the company has R1 in share capital. So in this case, you are low geared, and you would advise the company, if they want to take out a loan, they can consider it. So the question here normally is very specific. They will ask you, would you recommend a company to take out another loan, or maybe if they should rather sell more shares. Okay, so then the last one, the percentage return on total capital employed. There's a formula here, profit before tax and finance costs. This abbreviation here, earnings before interest and tax, divided by the average capital employed. So where do you find these two amounts? In the income statement. Now you must be careful and look closely. So we are looking for this amount, the profit before interest expense. We want that one. So you must be careful. If we give you the net profit after tax, then you must go and look for income tax and for interest expense and add it back to get to the profit before interest expense. Okay, sometimes we can give you the profit before tax, and then you will just have to add back the interest expense. So this is the one we are looking for, 296,600. Then the next part of the formula, we want the average capital employed. Now, what is average capital employed? If you look at your balance sheet, average capital employed, this means, where did you get your capital from again? From your shareholders and from your loan, your long-term loan. It's the average, so you'll have to take four amounts, these four amounts. If we don't give you the total shareholders equity, you will have to use share capital plus retained income plus mortgage bond for 1 year, for 2019 as well as for 2018, and you divide it by 2 to get the average. Okay, so this answer you also times it by 100. I just quickly want to mention something else here. Okay, this average capital employed, if you look at your balance sheet, if we don't give you this information at all, then you can also remember it's your total assets minus current liabilities. Okay, just something to keep in mind. I'm going to say it again, because your assets must be equal to total equity and liabilities. So if we don't give you this information, but you have the total assets and the current liabilities, you can deduct that and then you get the answer that you need to work with. Okay, now it is very important that this answer must be higher than the interest rate of the loan. It must be higher than the interest rate of the loan. A low return on total capital employed means the company is using its resources inefficiently. So if this answer is less than the interest rate of the loan, then you won't be happy with the answer. Good luck, and please, if there's any questions, feel free to ask your class teacher, or you are more than welcome to contact me as well.